We're jumping straight into energy fuels today. Everyone is watching the price action, but the real story is the collision of a global uranium supply crunch and the massive U.S. policy shift known as Project Vault.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get the ball rolling, just a quick reminder, if you like what we do, make sure you hit that subscribe button and give us a like. It really helps us keep the show going.
So yeah, it's February 2026, and you can just feel that the energy sector is in a totally different place than it was even a few years ago.
It really is. And energy fuels seems to be right in the eye of the storm. I mean, we're seeing price action that's waking up a lot of people. But let's get to the why now. Why this company right now?
Well, it's a classic supply and demand story, but with this huge geopolitical layer on top. We have to talk about what people are calling the uranium supercycle. For years, the world just leaned on Kazakhstan for uranium. I mean, they're the biggest supplier by far, producing something like 40% of the global total. They're basically the OPEC of uranium.
Right, the heavyweight champion of yellow kick. But normally when a price spikes, the champ just, opens the taps and stabilizes things. Why isn't that happening here?
Because we're starting to hear this narrative of peak Kazakhstan. They're running into some serious production limits, major infrastructure issues.
What kind of issues?
A big one, believe it or not, is a shortage of sulfuric acid.
Wait, back up. Sulfuric acid. Why on earth does a uranium miner need tons of acid?
That's a great question. It's because of how they mine. In Kazakhstan, they mostly use a method called in situ recovery. So instead of a big open pit, they pump a solution underground to dissolve the uranium.
And that solution is acid-based?
Exactly.
Yeah.
And because of supply chain problems in that part of the world, they physically can't get enough acid to keep production steady, let alone grow it.
So the biggest player on the field is basically getting sidelined by a shortage of basic chemicals. That's a huge deal. That sends a shockwave through the market, right?
It does. And if Kazakhstan is stalling, someone else has to fill that gap, especially with nuclear making a comeback as this, reliable, clean power source.
Yeah, you see all these AI data centers popping up and they need massive 247 power. Wind and solar can't always provide that.
Precisely. And that's where the U.S. angle gets so interesting. We're seeing this mad scramble for domestic supply. And it's not just the market, it's policy. We just saw the first new nuclear fuel license issued in 50 years.
50 years, that's half a century. I mean, that's basically the government admitting the U.S. fell asleep at the wheel on its own energy supply chain.
It's a massive signal. It's a full-on restart of the entire U.S. nuclear fuel cycle. And Energy Fuels isn't just watching this happen. They are positioned, right at the center of it all.
Because they have facilities ready to go.
They have licensed facilities ready to go while everyone else is still shuffling paperwork. In this industry, that paperwork can take a decade. Energy Fuels is already there.
Okay, so you have a global supply crunch and a local green light. That explains the excitement. But let's get into the numbers. Stories are great. Revenue is better. The trailing 12-month figures are pretty wild.
They are undeniably impressive. If you look at that trailing 12-month revenue, it just hit $78.4 million.
Okay, $78 million. Now, compared to the big tech giants we talk about, that sounds small. But it's all about the growth rate, isn't it?
That's the thing. It's a 103.7% increase year over year.
Wow.
They doubled their revenue.
They double it. Okay, now I'm paying attention. Doubling revenue in a heavy industry like mining that's a whole different ballgame than software. Is that just from higher uranium prices?
That's the key. It's not just uranium. A huge part of this story is the pivot to critical minerals. They're becoming this broader play on rare earths, on vanadium, and on uranium. They're diversifying your income.
Which brings us to their moat. What stops a competitor from just, digging a hole next door?
The moat in this business isn't the shovel, it's the license. It's all regulatory. You can't just build a new uranium mill. Energy Fuels owns the White Mesa Mill in Utah. It is the only conventional uranium mill operating in the United States.
The only one? That sounds like a monopoly.
For conventional ore, it effectively is. A new permit for a mill like that. You're talking maybe 20 years of legal battles and environmental reviews. They already have the keys to the castle.
It's a serious, serious advantage.
And they have rare earth separation capabilities at that same mill. This is where the geopolitical angle gets really strong. Because right now, China just completely dominates the processing of these minerals.
Right. And decoupling from China is the big theme. If Beijing decides to turn off the tap for rare earths that go into F-35s or EV motors, The West is in real trouble.
Exactly. So Energy Fuels is positioning itself as a hedge against that. As the domestic, secure alternative, they're basically building a toll booth for critical minerals in North America.
I like that, a toll booth.
Yeah.
Other people might find the minerals, but they have to pay Energy Fuels to process them?
That's the model they're building.
Yeah.
And the U.S. government seems to be on board. Let's talk about Project Vault.
Okay, what is that? Sounds like something out of a spy movie.
It's a massive $12 billion government-backed initiative to build up a strategic stockpile of these critical minerals.
$12 billion. That's not just a subsidy. That's a guaranteed customer with very deep pockets.
A huge one. And because Energy Fuels is one of the only domestic companies that can actually deliver the finished processed product, they are in a prime position to win contracts from this. It's a direct capital injection into their core business.
So the macro is there, the government is there, revenue is doubling, the market's finally catching on. What about the charts? I know we saw a big move around February 11th.
We did. The stock has been in a clear breakout. It's been trading in that $20 to $21 range. But the important thing is it pushed above its 50-day moving average. That's around 1890.
And for anyone not glued to charts, breaking that 50-day average usually signals that the short-term momentum has turned positive, right? Buyers are in control.
Correct. And it's way above its 200-day average, which is down around 1314. When you see that kind of separation, it's a sign of strong institutional buying. This isn't just retail traders anymore.
And speaking of institutions, Goldman Sachs just initiated coverage.
They did, and their price targets are looking up towards $30. Now, when a big bank like Goldman puts out a number like that, it signals to all the other big money out there, the pension funds, the mutual funds, that it's okay to get in the water.
It gives the whole story a stamp of approval. It's not just a meme stock. But $30, that's a 50% move from here. That's an aggressive call.
It is. It shows they're really buying into that supply crunch narrative we talked about. They see prices having to go much higher.
Okay, that's the bull case. It's powerful. Doubling revenue, a government backstop, Goldman's blessing. It sounds like a slam dunk.
But this is where we have to look at the other side of the coin. Let's break that down even further, because when I dig into the income statement, I see some things that are pretty concerning.
Right. We have to look at the flip side, because if you only look at the top-line revenue growth, you miss the ugliness underneath.
And it is a bit ugly. So revenue doubled to almost $80 million. That's great. How much profit did they make?
Well, there is no profit.
Okay, so what was the loss?
Despite the revenue jump, the net income was negative $97.7 million.
Whoa, a nearly $100 million loss. So they brought in $80 million and spent close to $180 million? That's not a business, that's a bonfire, pretty much. And earnings per share, the EPS, is negative 46 cents.
So for every share you own, the company lost 46 cents. Why? How do you lose that much money when your sales are exploding and prices are high?
It's all about the ramp up. They are spending an enormous amount of cash right now. They're restarting mines that have been shut down for years, upgrading the mill. All of that costs a fortune up front. It's all capital expenditures.
That's the classic cash burn.
A huge cash burn. They are pouring every single dollar they make, and then some, back into the ground to get production up and running.
So the bull case is that this is good spending, an investment in the future.
That's the bull case. But the bear case is that free cash flow is deeply negative. And unlike a big tech company, they can't do share buybacks to support the price. They need every penny.
And that raises the risk of dilution, right? If they burn through cash too quickly, they have to go back to the market and sell more stock.
It's always the biggest risk for a junior miner. They issue more shares, and your slice of the pie gets smaller.
And let's be honest, their execution hasn't always been perfect. Analysts have pointed to mixed execution and uneven quarters before.
Right. They don't always hit their own targets. Mining's hard. Things break. It's unpredictable. So the macro story might be perfect, but the micro execution can be bumpy.
And you really see that bumpiness in the stock's volatility. The beta is 1.68.
Yeah, that means it's about 68% more volatile than the S&P 500. This is not a smooth ride.
You need a strong stomach. This is not a stock for your grandma's retirement account.
Absolutely not. You can see 5–6% drops in a single day for no apparent reason. It zigzags all over the place.
And I've even seen some projections that revenue might dip in the short term, which seems totally backwards. How can that happen in a super cycle?
It's all about the timing of shipments. They don't sell uranium like a store sells milk. They sell it in big, lumpy batches. If a huge sale that was supposed to happen in December slips into January, the quarterly revenue can look really bad, even though the business is fine.
Okay, so it's a high-risk, high-reward bet. You're buying the story, not the current financials.
You're paying for the future monopoly, not the current cash flow. That's the trade.
So for anyone listening who's intrigued, what are the key things to watch for right now? What are the signposts?
There's a huge one coming up very soon. The next earnings report is scheduled for February 26, 2026.
That's right around the corner.
It is. And the market is expecting an EPS of -7 cents.
Okay, hold on. -7 cents is a whole lot better than the -46 cents we were just talking about.
It would be a massive improvement. It would signal they're finally getting costs under control. They're also looking for about $27 million in revenue for the quarter.
So the real tell is that EPS number, -7 cents.
That's the number to watch. If they beat it, if they come in at, say, -5 cents or even break even, the stock could really take off. It would prove the ramp-up is working. But if they miss, if it's -20 cents,
Then the cash burn story wins and the stock gets hammered.
it could get punished severely. So February 26th is a really big day for them.
Okay. What else on the macro front?
You want to see updates on that nuclear fuel license implementation,
Yeah.
and you really want to see concrete news on Project Volt funding.
We need to see that $12 billion actually start flowing to companies.
Exactly. Press releases are cheap. We want to see actual contracts. If Energy Fuels announces a specific contract from Project Volt, that's a huge catalyst. And finally, just keep an eye on Kazakhstan. Any more news about their supply problems just makes the case for domestic U.S. production that much stronger.
It all comes back to security of supply, doesn't it? The world is waking up to the fact that you can't have your most critical supply chains running through countries that might not be your friends tomorrow.
That's it in a nutshell.
All right, let's land the plane here. We've got the super cycle, the monster revenue growth, the monopoly-like moat. But on the other hand, we've got the terrifying cash burn, the dilution risk, and the wild volatility.
It's a fascinating setup. It's rare to see a macro story this clean with financials this messy.
So here's the closing thought for you to chew on. Energy Fuels is a high-octane bet on American energy independence. The provocative question is this. Is the market buying the current company, which is messy and bleeding cash, or is it buying the future company, the potential monopoly on domestic critical mineral processing?
That's the whole game right there. You have to decide if you're investing in what it is or what it could become when that government money starts to flow, and they really are the only game in town.
And just remember, that $30 price target from Goldman is exciting, but the road to get there is going to be a roller coaster. So don't bet the farm if you can't handle the ride. This is speculation, not a savings account.
Well said. Position size accordingly.
That's the lowdown for this week. If you got some value from this, do us a favor and subscribe so you don't miss our next one. We'll catch you then.